Okay, good afternoon, everybody. On behalf of NISM, I warmly welcome you to today's webinar, the Climate Ready Company, Resilience, Risk and Opportunity. Now, today's webinar is being organized as a special webinar on occasion of World Environment Day, which is June 5th. And it is especially meaningful that we're gathered here today, which is globally recognized as the World Environment Day. This day reminds us of the urgent and shared responsibility we have, not only as individuals, but as organizations and investors, to safeguard our planet and shape a more sustainable future. Now, when we talk about climate change, it is no longer a distant threat. It's a present day reality that's reshaping the way companies are operating, making decisions, and measuring long term value. For investors, this moment presents both significant risks and promising opportunities. Understanding how companies are building resilience, adapting to climate related challenges, and seizing new growth pathways is now essential to making informed and responsible investment decisions. Through this session, we aim to deepen your insight into what it truly means to be a climate ready company, from managing exposure to environment risks, to aligning with evolving global frameworks, and to capitalizing on the emerging green economy. We are joined today by a panel of experts who bring valuable perspectives from the field of sustainability, risk management, finance, and corporate strategy. I'm confident that the insights will not only inform but also inspire us to think more strategically and act more decisively. A brief introduction about the panelists. This session will be moderated by Dr. Miraj Inamdar from NISM, and we have with us Dr. Wasim Ahmed, Associate Professor at IIT Kanpur, Dr. Labanya Jinnah from the Asian Development Bank, and unfortunately, due to some unavoidable circumstances, Dr. Trupti Mishra could not join us today. Now, some important announcements for the participants. We will take all the questions at the end of the webinar, and please submit your queries in the question and answer session. The participants will be receiving a participation certificate within 3 to 4 days, and the recording of the session will be available on the NISM Tube channel. Now, before I begin the session, I will just give an introduction to what is NISM and the profile of various panelists here. So, the National Institute of Securities Markets is an autonomous institution established by Securities and Exchange Board of India (SEBI) to promote education and research in the securities markets. It offers various certification programs for professionals in the financial markets to enhance their skills and knowledge. NISM also conducts examinations and provides training programs to ensure regulatory compliance and professional development in the securities industry. To start with, I will first introduce our moderator, Dr. Mehraj Inamdar. Dr. Mehraj is a faculty member at NISM with over 13 years of experience in teaching, research, and industry. He specializes in ESG integration, BRSR, and sustainable finance. He holds a PhD from Mumbai University and has published extensively in index journals. Dr. Inamdar has led training programs for market regulators, international delegates, and industry professionals, and has received multiple awards for his research, including funding from the NYU Stern. Dr. Labanya Prakash Jena is a climate finance expert with over 20 years of experience across financial services, international development, and green finance. He currently works with the Asian Development Bank, IEEFA, Climate Trends, and CSI. He has previously served with organizations like CEEW, UNDP, and the Commonwealth Secretariat. Dr. Labania is leading the Financing India's Net Zero Targets Roadmap at Niti Aayog and is a co-author of the book Net Zero Trio, published by Bloomsbury. Dr. Wasim Ahmed is an associate professor at the Department of Economic Sciences, IIT Kanpur, with over 15 years of academic and industry experience. His expertise lies in climate finance and corporate governance, with a focus on firm level climate dynamics. A postdoctorate from LSE and a visiting fellow at India Observatory LSE, he received his PhD from the University of Delhi. Dr. Ahmed has been honored with several awards, including the Mahalanobis Memorial Gold Medal and RBI Fellowship. He also coordinates the Master's Online Program in Climate Finance and Sustainability. With this introduction, I would now hand over the floor to Dr. Miraj Inamdar to start the session, please.
Thank you, Rasmit, for introduction and also setting the context of this webinar. It is my privilege to welcome you all to this panel discussion on climate ready company, resilience, risk, and opportunity. So as we come together to mark the World Environmental Day and a global call for the environmental awareness and collective actions. So see, the urgency of the climate adoption is no longer a matter of distant concern. Because if you see recent writings and recent research which are saying that now the risk is no longer inside the balance sheet, but it is also outside the balance sheet as well. And especially the IPCC is saying that the climate change is going to impact the every region, every aspects of the life, and business is one of the aspects of it. In fact, World Economic Forum for last 3 years they are saying this in their risk report, global risk report, that uh, um, 5 out of 10 risk for the upcoming 10 years is from the climate, from the different areas of the climate change. And so the businesses are also going to impact this change. And see, this is not only just the risk which is the businesses are facing, but it's also a opportunity for the strategical thinking for the businesses, or to making an innovative development, to making an adaptation, to making a transition towards the more sustainable companies. So this panel discussion, we are trying to address or trying to discuss or more insight about our very esteemed panel members from academia as well as the industry and consulting area, to dig deep down into it and saying that what actually happening with the company and how we can address this issue or to understand it more in deep. So, with this, I would like to ask Mr. Labanya Prakash Jina. So, see, earlier we have seen, especially in case of some developed countries, they were in a denial of the climate change. They were saying that it's a evolutionary process. Means earlier we had a warm environment, then after we have seen the ice age, and then we are seeing the warming. So it's just a evolutionary process of Earth. So they were in a denial, but then after the lots of research comes, and they are saying, it is saying that it's because of the industrial revolution. So my question to you, is it also happening with the this skeptics around this climate risk for the companies? So how you will address this, that the climate is are means those who are saying it's a very overstated, it's not going to influence the company, or it is happening, means just the evolutionary process, or business will not impact from this. So how's your insight about it?
Yeah, thanks, Dr. Biraj, and thanks for inviting me. And good to be here. Um, and particularly NISM is organizing this kind of event so that the people who are going to join the financial sector, I'm hoping that they can move the needles and reorient the capital for climate actions. Okay, those deniers are still there. We have political leaders in large economies, and unfortunately are climate deniers. So okay, I cannot take them their names, because somebody will say that okay, you cannot enter my country because you are against my belief. Okay, coming back to companies, you cannot say that I am climate resilient or I will just ignore climate change. It is affecting you, it is affecting your business. But we cannot say that it is affecting everybody equally across the sector or across the industries or across the economy. But everybody is more or less affected. So there are enough academic research been produced and also anecdotal evidence who suggests that climate change has affected the financial performance of companies. For example, a recent California fire, okay, before the California fire happened, so a couple of months, or 1 year, 1 or 2 years before, the insurance companies, they said that we are not going to renew those real estates for no more. Okay, the one of the reasons here they said that because of heat waves as well as persistent drought in the region, so those areas are fire prone. Okay, so what is the reason of drought in California for extended period of time? What is the reason of heat wave? It's because of climate change. So as an insurance company, their bottom line is getting hit by climate change because they understood between 2017, particularly Hurricane Katrina event, because many insurance companies they lost their balance sheet. Some of them also declare bankruptcy because they didn't have enough equity capital in the balance sheet to cover their payout. It means that it is hitting them. It's not the only evidence. There are other evidence also. For example, in Miami cities, the all the properties, many properties are no more insurable. Insurance company are saying that we are not going to insure that. At the same time, there are also evidence suggests that commercial banks who have underwritten those properties and loans in their balance sheet, they are apprehensive about the loan performance. What they are doing, they are moving away those loan books to the capital market. And the bond buyers, they don't know actually what are the contents of the loan, what are the quality of these loans. It's not only there in the United States, it's happening here in India as well. If you, I was speaking very casually with a brokerage house as well as commercial banks here in India. They told me that they are concerned about the flood events in Mumbai, in flood events in Chennai, even Bangalore also. The property prices which are prone to flood events or water stress, those property prices are not increasing, or sometimes there are not enough liquidity in property prices. Even some of the insurance companies also, they have increased their insurance premium in those areas. Okay, so it's all because of climate change. Businesses are really getting affected. Okay, so we cannot deny that that climate change is not happening if you believe in science. For example, all these companies, many companies are coming out, are taking internal carbon pricing in their capital budgeting decisions. Okay, what is the reason of that? Because they understand that the carbon pricing is virtually not existence in the country because we have a voluntary carbon pricing mechanism. But they understand that the life of their asset is 20 years, 30 years, or 40 years. If they don't include carbon pricing in their capital budgeting decision, their cash flow might be overestimated right now because at some point of time, because of carbon pricing, their cash flow will be deteriorated. So it is wise for them to include carbon pricing right now. Some of the IT companies, they have considered carbon pricing more than $50 per ton. Even Tata Steel, they are considering close to, I think, $25 per ton. Even JSW Cement is, JSW Steel is considering, I think, $20 per ton. But they are not paying anything to the exchequer. Still, they are considering because they foresee that because of the transition risk, one, I mean, carbon pricing is one of the transition risks. When the company transition to a low carbon economy, they have to pay that. Okay, so they are cognizant of this risk and they are preparing themselves. Okay, we need to face in the future. Let's take steps so that we can protect our businesses. So we cannot ignore climate change risk at all. I mean, some of the time also, in last 2 years, we can see in the monetary policy document as well as last 5 years in the banking report, annual banking report published by the Reserve Bank of India. They also keep on saying that climate change is creating inflationary pressure in the country. Okay, we should be. That's the one of the reasons why they have come out with so much of guidance, although it is not mandatory to include climate change in banking supervision, but it's not a part of that, particularly in banking disclosure. So it's real, it is happening. So we can see that in the economic survey, almost all the chief economists are who are objecting what called climate change risk in the economic survey. So it is real. Even politicians also recognize sometimes just to win their when the voters win their constituency, they ignore that, but it's happening. It is going to hit more in the future.
Yeah, of course. It's real and it is happening. So I remember one of the presentation of Viral Acharya, who he has given one presentation in NISM during one conference, and he mentioned that how this heat waves is impacting in UK industrial this chocolate industry. Means because of the heat waves, the production of milk has gone down, and because of this, milk was the raw material for the chocolates, and because of this, the production cost has increased and profit margin has decreased. So their debt servicing has decreased of this company, and this causes a the credit risk, causing the systematic risk for the whole of the banking system of the UK. So thank you, Gina. You have mentioned a very important thing, that the various economic survey also recently are emphasizing this thing, and also in industry, company-wise balance sheet also we are seeing. But quickly, I would like to ask one thing, that you have also mentioned the carbon pricing. So are these companies are theoretically counting out it, because I have not seen, mean they have cash out this carbon credits yet.
No, when you are doing a capital budgeting decision, it is theoretical in nature because you don't know how much cash outflow is going to occur in the future. It is theoretical exercise, but since you are cognizant of this risk, which will emerge in the future, so if you consider climate change risk today, for example, if you are finding on some certain certain cost of capital, certain cash flows, that okay, your net present value is positive, you will take a decision, or your IRR is 12%, so I'll go ahead with that particular decision. But you are underestimating carbon pricing. But suddenly, if you are going to see carbon pricing in your cash flows become negative or less than the expectation. It means that it will going to hamper you. But I understand your point. It is not affecting their current free cash flow generation. It may not affect their free cash flow generation in the short term, but it will definitely going to hit them in the long term. Okay. So one of the reasons why they are considering long term, particularly these capital intensive industries, for example, steel industry or cement or so, this kind of asset are very long term. They will stay invested for 20 years, 30 years, or 40 years. Okay, when your asset life is very long, okay, your cash flow, projected cash flow generation is very long. Okay, you can only recover your money and generate return on equity of 15-20% if your asset survives that much. Okay, but by huge incorporating carbon pricing, then you think that okay, it will make money what I expect. But suddenly, if it is affecting it, if suddenly let's say India announces carbon pricing starting with $5 today, $25 after 10 years, okay, then you will see that your carbon price, because of carbon pricing, your free cash flow generation is diluted by let's say 20% or so. Then you are in trouble, or your mathematical calculation will go nowhere. Okay, so although it is a theoretical exercise, but I think it making sense actually since you are considering. Secondly, uh, as you know that many equity investors who are putting equity capital or bond investors whose investment horizon is very long. I'm not talking about bond investors in India where most of the duration of bonds is between 3 to 5 years, not really long term, or banking capital which is only for 2 to 5 years or maximum 7 years or so. Okay, you may not face the transition risk of carbon pricing suddenly, but from an equity investor point of view, it is very, very critical. You are presuming
Okay.
that you are going to hold the equity shares for a long time, or you are hoping that there will be continuous capital appreciation, that you can get out of your equity investment at any point of time. There is something called terminal value, which I kept on doing when I was an equity analyst. So that's
Yeah.
terminal value because it is going to be affected significantly. Most of the time, we calculate terminal value after 5 years or 7 years timeline, and it depends on free cash flow generation after 5 years or 7 years. Then suddenly you will say because of carbon pricing, the free cash flow has been hit by 50%, and the terminal value is not going anywhere. Okay, so as an equity investor, you should be much more concerned because you are hoping that the company will stay for the business. The company's free cash flow generation will be perpetual in nature in the future. So if you are not cognizant enough, then you will be in trouble.
Yes, of course. I will come back again to you on this concern of the investing, sustainability investing, but because last 2 years, lots of things is happening in that area. As you have mentioned the mathematical model, so now I'd like to ask Dr. Wasim. So, sir, for last means in traditional finance, we have learned how to quantify the different models. So we generally using the inputs of the or calculating the beta, calculating various CAPM, DCF modeling, valuation modeling, and now incorporating this non-financial factors into the modeling. Because your very most citedly paper, optimal hedge ratio in 2018. How do academic models capture this complexity of the physical and transition climate risk? And what are their limitations? How to quantify this? Sir.
Thank you, Miraj, and thank you, NISM, for having me, and thank you, Lavanya Prakash Jana. I think it is wonderful to hear from you. You have been one of the experts in the country, and really proud of you doing good work in this direction. And coming back to the model, I think if you look from the economic side, because I come from there, William Northus is known for having the only economist seeking attention on climate change since 1970s, and his DICE model is very popular, which is about the dynamic integrated model, so integrated assessment models about climate change and economy. So under that, they use hazard model and nonlinear setup, and they try to capture how much is the GDP loss because of climate change. And then we had a further generation of models, and that helped to understand us from the macroeconomic side, that if you have a per capita income loss because of climate change, then how it is going to happen. Recently, Fung, F-U-N-G, by the famous economist who is also the chief editor of Energy Economics Journal, Richard Toll, he also talked about the diversity in terms of macro scenario. But this webinar is all about micro because we are talking at form level, right? And form level dynamics, if you ask me as an academician, I'm very excited about the disclosures and sustainability and the data because I'm going to get that data and I'm going to use that in the model and give the analysis which is going to be available in the public domain. So whether it is investor, whether it is the company promoter, anyone can read and understand, right? So for example, if you want to understand, we were talking about the carbon pricing, whether the companies are including the carbon factor into their valuation or not. If you just take into account basic CAPM setup, idiosyncratic risk, which is just the residual that we get from CAPM model, right? Or farm French, you can take a farm French 3 factor. Now, if I'm working out that kind of scenario, so I recently worked out a paper on that, and I found that we have very limited data. For example, measuring physical risk is a big challenge. So what is the option right now? We have the text setup, natural language processing. And under that, what we did is that we had to go through a lot of newspapers and find out the keywords related to climate change. And that looked very raw that, okay, randomly we are picking some words and trying to map it through some dictionaries. And then we are getting the idea that how this particular physical risk has to be measured regarding flood. We have cyclone. We don't have hurricane in India, but we have a cyclone, right? We have flood. We have heat waves coming in some areas. We have severe winter also experienced in some areas. So we gathered those, and finally we constructed an index. But if you want to work on Indian setup, it is still a big challenge in terms of data availability. If you want to work at form level dynamics, you need to really get the quality of data that you get in case of US and some advanced economies. So I would say that in terms of modeling, if you want to work out, for example, you mentioned about optimal hedge ratio. So we worked out with the dynamic scenarios and we created a dynamic hedge ratio using different volatility models, time varying volatility models. The idea was that how we can combine clean energy with crude oil and the technology stocks. And we were able to do, and it appeared that the crude oil was the winner. So you can combine and you still hedge at the cheapest price, right? But in 2025, if I as an academician, I look at, find a major gap with regard to two things. One is the tail risk. Can we measure at high frequency climate risk? Because most of the people, they work with yearly data. And yearly data is like, in finance, yearly data is like you are dead. And unless you are working with balance sheet and some kind of corporate finance literature. So tail risk is a major challenge. So what we can do is that we can think about integrating the data collection at unit level. So can we get the farm level data where it is located, GIS based information, and that can help us gather details, and then we can analyze with certain loaded factors and see with moderation and moderating effect. Second is about the stress testing, which is becoming a major challenge, especially for the banking sector. It is a challenge. So can we incorporate something of that sort? Third is about value at risk kind of model. Can we incorporate climate change risk into the value at risk? And can we get something called fiscal value at risk, which means that which can capture the fiscal risk of the climate change. So in finance, I think these are the areas where we are looking at right now, and maybe going ahead, we'll try to touch upon. The third thing is about the network models. Can we see the integrated companies if we have a conglomerate which has 10 plants across India, and some of the plants are located at vulnerable locations which are more climate prone. So if the risk is high, then how we can measure that? So at macro level, I recently explored a topic on how long, or how can we say that whether the climate change risk is being priced in the monetary policy formulation. So we found that it is still not significant with regard to repo rate, but it is a systematic risk factor, and the climate change impact with regard to inflation, it is more impacting the rural areas, not in the urban areas, but rural areas it is getting impacted. I think I also came across one news about default cases in some of the regional rural cooperative banks in Odisha because of the cyclone. So there were cases which are not in the limelight, but it has come to notice that some of the loans are getting bad because the SMEs are not able to pay back because of the climate risk. Food and non-food we also looked at, and we found that it was quite useful. So coming to the model, we require a good data, and SEBI has to do good job with that regard, and we should have the platform so that we can access that data and give insight to the public domain. We are not achieving growth at the optimal level right now. Our economic growth is at suboptimal level. So 6.57% is not good for us. We cannot survive with this unless we go into double digit. So enforcing climate requirements right now on farms may lead to financial instability kind of scenario. So it's good that SEBI has put a check on that and made it voluntary as of now. But if you're going to make it mandatory for everyone, like right now under BRSR, we have put some efforts. It will be a big challenge because this will create a lot of financial instability scenario. There will be a lot of loan cases. As a company, I can borrow money and go for climate change measures, transition risk, moderating effect. But whether I'll be able to pay back that money to the bank, I'm not sure. So if my financials are not okay, I may have to go for bankruptcy. So enforcing that kind of rule, I think that's why we have also gone down with the carbon trading setup. We saw last year we were very much excited, but in 2025 we are more into the CCTS kind of setup, right? But it is bound to come. The data is going to be the gold. So now it is no more a disclosure requirement. So climate change is no more a disclosure requirement. It is a climate champion kind of setup we are going to have. US and all other economies, they know that their people are working already on the ground. As the Dr. Jena mentioned about the Miami and the California fire cases. So they know they have the product already in financial market. They can easily launch. They already have the derivatives launch on hurricane, water. They also have derivatives on frost. A lot of weather derivatives are already available. So insurance companies can use those derivatives to hedge the money. It is just the political gimmick that they are playing with, but it is bound to come, and the data availability will be a big help for us as an academician. So I hope I have tried to, and I have given you your
Yeah.
answer to your question.
So thank you, Professor, especially giving a lots of hypotheses to young researcher. So those who are the researcher attending this webinar and this panel discussion, this is the recorded session, so it will be available on the NISM YouTube channel also. So you can rewind and see what insightful hypothesis sir has given. Sir, you have mentioned about the BRSR. So as lots of data disclosure are happening by the companies. So, do you think that it will change the thrust of the this or data quenching of the researcher related to the sustainability or modeling? Lots of data BRS are also having, which the
Mm.
company is disclosing. So, what is your view on
So,
this
so,
BRS?
so recently, I think SEBI has put some kind of guideline related to ESG data availability. So, a lot of databases are not giving data on ESG as of now because they're waiting for SEBI approvals. But if you think about the disclosure at the firm level, for example, even if they are going for sustainability disclosure, it is not only going to help them in seeking further directions about their product development, their expansion. It is not just for the researcher, but it is for the company also, because company can have better decision making. They can have their own data analysis team. They can have their own, I would say, projection team that can project cash flow, that can project the capital allocation, and more importantly, the complex model that we are seeing these days. We are in the era of complex models, right? So chat GPT and all that kind of setup we are looking at. So whatever is available on internet, we can extract and give a particular shape and share with everyone. Companies will also have the benefit in making decisions, in also proving themselves that they are better than others. If you're just selling a product, so recently I worked on fintech and I found that in India, if you are innovative company, you have very limited chance of survival. But if you're imitating, if you're copying, then you have better chance of survival because you can work on a smaller margin and survive. Because if you are innovative company, you have a very high chance of copying your product. And as a result, you may be out of the market after some time. We did that kind of work. But I'm saying that if you have a company which is producing a very unique product and you have sustainability backed up also with a lot of indicators in the public domain, and it is available for everyone, everyone can see, analyze. And that gives a lot of flexibility to not only investors, it also gives to consumers, suppliers, as well as regulators. And regulators will be more than happy to also give emphasis. The credit availability will be easier. Banks would like to give them some kind of discount with their rates, that if the company is really doing well on sustainability. So I'm saying that in terms of BRSR, we have put just a guideline that this is what we expect. It is an evolving paradigm, so you'll see that a lot of matrices will be added later, and we will be also going at micro level. The real game in India will start when it will go on to the SME sector, because there we have the gold, I would say, in terms of data, that is the gold mine that we have. Because there we will find a lot of good chunk of data at micro level, really tiny level, and then we can see how climate change is getting that. And data science, I think, I as an academician, I'm quite bullish on this BRSR setup, and I'm thankful that we are now going to that direction. But SEBI also has to think about hedging opportunity, what it is going to give to investors. So they must be now looking for whether derivatives launch on the, in terms of derivatives, it should be launched on the Indian stock exchanges. For example, we have MCX, we have NCDX. Earlier it was Forward Market Commission, but now it has come under SEBI. So now I think SEBI should allow the introduction of innovative products like weather derivatives. We can also think about now Corsia is also having a lot of say. So we can think about having some internationalization with the financialization of some of the products that we already have. Jal Shakti Ministry is already working with piped water. So we can also think about the water rights, because in the cities, especially in Bangalore and all other cities, water is a major challenge and climate change is directly attached. So at what rate the industries will be buying, how they will be hedging, people who are living in the gated community, how they will be hedging the water price increase. So this will open a new set of, I would say, avenues for not only the companies getting into sustainability, but also how they can make money and further put it in put those efforts in a more sustainable manner. So that is the take, I would say. I hope I have answered. So thank you.
Yeah. Thank you, sir. So, Dr. Jina, you were discussing about equity investing, and sir was discussing the BRSR. So, see, one side the companies are disclosing lots of things happening at a micro level. They are doing a stress testing, they are doing a scenario analysis, everything. And the other side, the investment side, we are seeing the outflow from the ESG mutual fund, which is not very means have a connection between these two things. If you see for last 3 years, almost 1,000 crores of the outflow in the this 11 mutual fund, and for last 3 4 years we have not seen any new mutual fund coming in the ESG front, even though SEBI has categorized the ESG as the thematic mutual fund. So what could be the reason for this?
I think that retail investors, they are not worried in India actually, whether you are ESG or climate change doesn't matter to them. For last 5 years, what we are seeing that there is a boom in the stock market. If there is a boom, you are not worried about any risk, okay, be it climate change or the war or any of this risk. Okay, that's one part. So since retail investors are not worried, it is, I mean, in the European Union or US, mostly demand is coming from the audience, actually from the investors. Investors could be institutional investors, investors could be retail investors. Then secondly, somebody told me that the distributor who are responsible in marketing this financial product, they are saying what is the benefit of selling a ESG mutual fund? Okay, I'm not deriving any additional commission, so I need to explain a lot to my potential investors. Okay, these are the benefits you are going to derive. Okay, that's another reason that nobody is going to spend time and convince ESG investors, potential ESG investor, to invest in ESG mutual funds. That's two. Number three is that, as you say correctly, most of the ESG mutual fund launched in 2021 during the peak of COVID-19, and many people thought that it is better for the society put their money in good companies. But if you dig deeper, you'll find companies like banks or IT companies, they are in the ESG portfolio. And nobody knows that whether these banks and the IT industry are not really helping in making the world better, both from the climate change perspective or governance or society perspective. Nobody knows. And suddenly during that time, the oil prices also increased. Okay, since the oil prices increased, okay, you will see that most of the ESG funds, they underperformed, okay, compared to the market. Okay, so there are multiple reasons for that. I mean, there are no demand. Okay, there is a cost for the distributor also. Distributor don't want to spend additional time. There is underperformance of ESG funds in India, and there is a stock market boom. Everybody was making money irrespective of the funds you are putting your money. So these are the reasons why ESG funds didn't click in India. Although I mean, SEBI came out with different categories of ESG funds. I think 4 to 5 categories, if I remember correctly. But it doesn't matter actually. Not a single mutual funds came out with a new ESG mutual fund product. Okay, but the reason is they realized that okay, there is not enough takers, enough demand in the market. Secondly, I would like to emphasize, would like to understand that from a practitioner point of view, as well as for students, we need to see that whether ESG fund is really making sense. Ultimately, you are making money for your investor. So, Ajay, let's say if you are an asset manager, your fiduciary duty is you to your investor. Your fiduciary duty is not to protect the planet. Okay, you cannot compromise that. Okay, that's one part. Second part is that whether ESG fund is helping the investor in increasing the return or reducing the risk, which we can risk adjusted return. I mean, academically, it's not proven, although I can see some of the consulting companies, and I'm a part of that as well. They say that, okay, if you invest in ESG mutual fund, your risk adjusted return will improve, but which is, I'll say, bullshit. Okay, that's not true. You are mis-selling a financial product to investors. That one part. Second part is that whether you are really helping in making the world better, that is also a big question mark. Okay, and third part is that when the ESG fund launched, there are not enough pure play renewable energy companies. And mostly the ESG fund, you will see that I believe that it should be pure play renewable energy or clean companies rather than companies which are in muddy water like Coca-Cola or so. You don't know whether Coca-Cola and which is using extensive volume of water, British Petroleum, you will find them in some of the ESG mutual funds also, which doesn't make sense at all. Okay, I will say that this is mis-selling of financial product to investors. So these are the reasons I will say that which why ESG kind of products is not big hit in India. Thirdly, compared to European Union, you will find the people who are in the ESG team, okay, they are somewhere in the ESG investment team. Nobody listen to them. Okay, very frankly, they will come to the ESG fund investment committee meeting. They are only for financial investment reporting, nothing else. They are not part of the investment team. Okay, it means that are you really integrating ESG in your investment decision? It's a big question mark, and many people say that they will only see that which are the companies who have good ESG rating. Let's include that. Okay, then they will say that okay, whether it is aligned with a broader index. If it is aligned, let's create portfolio according to that. You will not find a lot of misalignment between a ESG mutual fund and a broader market, because ultimately the portfolio manager will be punished in the market. So every day or every quarter, so the portfolio manager commissions will be reduced because the portfolio manager put the money in companies which may do good in the future in the long term, but nobody knows. The life of the fund manager is very short. Okay, it's very difficult job for a fund manager as well.
Yeah, agree. So, Lavanya, you were discussing about the mis-selling, and so my question to Professor Wasim, because internationally, various fund houses, if you are seeing their marketing pitch, so there many times they cite the academic research that ESG integration is impacting financial performance. Although it's one of the hypotheses in my PhD also, by doing various panel data analysis. So why there's even a various meta-analysis also saying that the integration of the ESG is impacting financial performance, and that then if it is impacting positively financial performance, then why not it is inculcating in the valuation and attracting more investment into this. So is there any flaws in the methodology aspects of evaluating this thing?
I think it is a very interesting question. So let me, I think, try to connect with some of the special products that we have. So in India, we have pure funds, right? So pure funds, what we do is that we go for filtering. So it is filtered fund. So ESG mutual fund is also a filtered fund, right? Because we are just filtering some companies based on sustainability and creating a fund and selling to investors. But if you compare the pure funds performance, which are like almost same as we have for the normal mutual fund that everyone is investing, uh, ESG funds are not up to that mark. Why? Because of the investor perception, credibility, that whether ESG declarations are up to the mark, whether companies which are included in the mutual fund portfolio, whether it is accepted, the numbers, So what has happened that we have launched the product earlier than prioritizing ESG. So ESG is the key here. So how many investors in India are aware about ESG? If you ask them, they will say, okay, yeah, there is a term, yeah, I read in newspaper. So a lot of investor awareness work has to be done, which means that it is not related with climate itself. It is a financial product which is being guided by the SEBI, and all the companies have to comply. So if in a simple language, if investors are ready to digest this, they will be ready to put in money and liquidity will be there. Otherwise, what has happened that we have gone for a front loading. So we have loaded the mutual fund because mutual fund industry found it quite easier that you filter a certain category of companies, form a portfolio, and let's sell it. It will not be sold that easily. Right? In India, the individuals are more inclined towards gold. So gold is actually the winner, irrespective of what we do with equity, because households are more inclined towards gold. I'm saying that ESG, we'll have to give some time. We can't just compare with the normal funds which are existing for years. Maybe after 5 to 10 years, when we are more streamlined with BRSR and further expanding the number of companies, number of sectors, when the coverage goes up, there will be a natural inclination toward these funds, and these funds will remain a good option for those people who care about environment, who care about and you don't need 5 crore investors. Even 1 crore will be more than enough for a fund to survive, or if subscribers are even close to 50 lakhs. If you think about the major cities, metro cities, it will be more than enough. But problem is that we need trust, we need credibility, and this will come only when data is available in the public domain, when anyone can see, analyze, and understand, then only people will have faith, believe. It will be written in newspaper, media, podcast. People will be talking about that there is something new product in the market. Otherwise, finance will be keep on writing that it impacts positively to financial performance. The data crunching exercise will go on, but on ground, the impact will be very less. For example, you can see the faith-based investment that we see, right? Islamic finance and all these things. They are surviving because they are connected with the faith. And there is a huge amount of money pumped into this particular kind of ideology-based investment. In the same way, climate change is also an ideology. I find that if you are interested in environment, if you think that there is only one planet and will not have a second option, then we have to think about safeguarding it, and people will incline. I think I was recently reading a Wall Street and alignment also that Gen Zs are more attracted towards the companies which are focusing on sustainability. Right. So over a period of time, it is a lifestyle case. I think we'll have to give some time to the ESG, but please do not connect with the research that we are doing in the journals and the reality on the ground. Both are different, contrasting. That maybe because data is showing that impact, but it has not reached to everyone. So I think
Okay.
SEBI, I think your job is more crucial here to prioritize and spread the news across all individuals.
Agree, sir. So very rightly articulate and very bold statement also means that the data is needed in to be connecting reality with the theoretical models. So now I would like to ask this last question to Lavanya ji. So what does a climate risk ready company of 2013 looks like?
Okay, when I say that climate ready companies, so one is that you need to identify your risk. When I'm talking about risk, it's not risk for the next 1 year or 2 years, a risk perpetually, because when you talk about any companies, we talk about risk in perpetually. Definitely, you cannot say that, okay, risk is going to realize after 50 years or so, but let's say 10, 20 years or so. I'll say that you need to see that what is the life of the asset you are investing. Okay, if the life of the asset is very long, for example, any steel companies or airlines or cement industry, even consumer products also. Okay, so if your life of the asset is affected by any risk, and you need to manage that risk. Okay, some of the time your life of the asset is very short, and you are not required to manage that risk at all if it is not going to hit you. Okay, hit your bottom line during the life of the asset. So it is a combination of investing in low carbon technologies, which is necessary. I mean, we keep on saying that carbon pricing is not going to be compulsory, particularly in a bipolar society currently we are going through. So every country is saying that, okay, we can take care of ourselves. We are not talking about creating a global public good or climate mitigation. But at the same time, at some point of time, every politicians would realize that, okay, like Professor Wasim said, that is the one planet, we need to save the planet. And the only way is that you invest in low carbon technology and reduce carbon emission. Okay, so the company needs to invest this capital in low carbon technologies, and I believe that it will help you. It will help the company. That one part. Second part is many times we forget the physical risk part as well. Okay, in that aspect, you also need to see that how the physical risks are going to affect your businesses. And there are ample examples also. You'll see that companies are diversifying their asset base, shifting their manufacturing facilities as well, and erecting new assets to just to protect their assets. Okay, developing their supply chain. I remember that Professor Wasim, Dr. Miraj, you also said in what happened in the UK. So Unilever actually they were, as you know, that they produced chocolates, and they were not getting good quality of cocoa from Brazil and Africa. So what they did, the company went to Brazil and Africa. They started imparting training to farmers. Okay, how to produce good quality of cocoa, and when the temperature is 45 degree or so. Okay, it means that you are investing in climate resilient initiatives. So also it is a combination of investing in low carbon technologies and investing in climate resilient activities. So you may compromise your return on equities or return on assets, and your shareholders may be unhappy, and the stock market may not be reacting to your behavior, to your capital allocation behavior. But if you continue to do that and convince your shareholders that so that CEO will not be thrown out, nowadays the duration of the CEO actually decreases, shrinking day by day. So it is a good business, and equity investors will make money, and it's good for the planet as well.
Before I move to Professor Wasim, Lubna Jina, you were also part of the various forum of this transition finance. So, in context of India, how this is developing? Can you summarize quickly what is happening in this area?
I mean, you're talking about just transition or transition, so I need to
Uh,
differentiate.
so, for the audience, you also make the difference between this transition and just transition.
Okay. So when we are talking about transition, we are transitioning from a highly carbon intensive economy to a low carbon intensive economy. For example, I mean, unfortunately, I mean, our entire economy is dependent on energy, unfortunately, and the source, I mean, the energy is very, very carbon intensive in nature. And now we will continue to rely on energy, maybe less volume of energy in the future, but the energy will be less carbon intensive. It could be renewable energy or so. Ultimately, that will help us to reduce carbon emission. Okay, to transition from a high carbon economy to a low carbon economy, okay, we need capital. Okay, that capital we can say that transition finance, but that at a macro level. Okay, some people say green finance, some people say it's a climate finance or so. That is at a macro level transition finance that will help the economy shift from a high carbon economy to low carbon economy. But at a micro level, what the transition finance is understood, there are certain industries which cannot reduce their carbon intensity very, very quickly. The industries could be cement, could be steel, could be airlines, could be shipping. Okay, so or chemical industries. Okay, or even agriculture also. Okay, because of the financial reasons or because of the technology reasons. Okay, so they will take a longer time to reduce their carbon emissions significantly, or it's net zero if we trust net zero. So that's a different question altogether. But they can reduce their carbon emission over a period of time. So the capital which are going to this company to reduce their carbon emission maybe gradually over a period of time, that we call transition finance. But transition finance has not been popular so much actually. So although transition finance used long back, I think 2017 or 18, it has not been successful yet. But till recently in Japan, many of the industrial companies, they issued transition bonds, and which is an encouraging sign for countries which are heavily dependent on manufacturing. It is very, very important for countries, particularly for developing countries, because the developing countries' economies are mostly manufacturing intensive, unlike India. So we directly moved from agriculture to services instead of manufacturing. But still, our economy depends on manufacturing to provide jobs to everybody, because services economy, you cannot provide jobs to everybody. So transition finance is very critical. Very in a layman language, you are providing company capital to a company which are going to reduce carbon emission gradually, not significantly. In the case of electricity, it's very, very simple. You provide capital to renewable energy company and you are shutting down coal plant. Okay, you are just substituting coal plant. You can reduce carbon emissions significantly and very, very quickly. For transition finance, it will take a longer time. Just transition is that because of the transition to a low carbon economy, there are certain sections of the people who are going to be adversely affected. Okay, they will lose their jobs, they will their livelihood at stake. For example, our three states in our country, Jharkhand, Chhattisgarh, and Odisha, we are heavily reliant on coal. And here we are talking about transitioning from coal to renewable energy. Most of the renewable energy development is happening somewhere in Tamil Nadu, in Karnataka, or Gujarat, or Maharashtra. Okay, it has if this development are happening, it means that we are not going to depend on coal in these states. So what is going to happen to these states and the people in the states who are directly or indirectly engaged in the coal sector? What is going to happen to the tax or revenue generated by the government, which is going to spend on social welfare? Okay, here you need to take care of the people who are going to be adversely affected with this transition. Okay, you need to provide, let's say, training, you need to provide alternative livelihood, so that the training is very much essential, so that they can be a part of the low carbon economy, they can be employed as well. It is a long discussion, Dr. Miraj, so I'll stop here.
Yeah. I agree. So sometime later we will have this. So Professor Wasim, Labanajina has started this discussion of the carbon pricing, and you are also a part of various industry, various government bodies, advisory bodies. So what is happening in this carbon trading area, and how for it is beneficial for the listed companies?
So thank you, Miraj. Especially for hard to abate sectors, it is some kind of challenge, but at the same time, it is also an opportunity. For example, NTPC, if they are going to get affected because of the carbon trading, so we have a PAT cycles, and then we also went through. So PAT cycle, it was not that harsh with regard to target, so it was not that effective. But what it did was that it increased the efficiency of these companies. So they started working on. So if you think about a scope one did not change much, but these companies were able to improve upon the scope 2 and the scope 3 much, because if you have old machinery, you can replace by new. So it became some kind of capex kind of model for these companies to improve upon. But carbon trading as such, you will be happy to know that majority of these companies are also owning a great amount of credits, and that they are waiting that once the market opens and they will be in cashing it, because what has happened that they've also gone for investment in renewable energy. So side by side, even if NTPC is having a power plant, a coal-fired power plant, they also have investment in some alternatives, alternative energy, and that has created a big, I would say, buzzword. Second thing, for example, hard to abate sector, if you think about cement and others, in cement you have a carbon capture playing an important role. So that innovation is also helping a lot of companies. You also have, for example, in India, we don't have that kind of option available, but you can think about switching cost. Switching cost in the sense that if I'm producing, I would say electricity with coal, and when I find that the carbon prices are going up, I can switch to some clean fuel, for example, gas. So I'll be using gas. But unfortunately, in India, we import gas also, and we have a coal also imported, so that becomes a very difficult challenge. But switching cost is one scenario. Under that, whenever we find that the carbon price is down, we move to coal. But uh, the major challenge for Indian government as of now is that what should be the price of carbon credit, which we are going to emphasize on the exchange. If it is too high, companies would like to invest and they will be getting away with the carbon requirement, and they will not be buying at all. Right. So, for example, energy saving certificates, we saw the glut because of the PAT cycle, right? If it is too low, then companies will not be taking seriously the climate change. So they will be buying the carbon credit and getting away. So which means that what should be the optimal price? So optimal pricing, because of marginal abatement curve and those things, we calculate MAC analysis, but it is still a big challenge for the government, also regulators also. So CEA has been given the task to bring out the guidelines. I think in terms of carbon setup, in terms of voluntary, I find India as a big opportunity. It is getting attention in international market as compared to Chinese credit, that we saw a big debacle about their quality of credit. In India, we are finding that major brands are buying. For example, Shell is one of the major buyers of carbon credit, and in carbon sequencing also we are finding a good amount of investment. REDD plus, we have a good amount of investment coming in with nature-based forest product. So voluntary, I think it is going to play an important role. I am waiting for a day when I can think about that. If I have to celebrate my birthday, I want to be a carbon free, and it should have the tokenization, which means that I want my birthday to be carbon free. So I can, whatever emission or emit I'm going to do with my birthday celebration, I can buy that number of carbon credit online. And then whatever you call it, greenwashing or something, but at least it will help in some way or the other, right? But or if you're traveling from one location to another, and you can simply see how much carbon you are going to emit, and you can buy that. But that will be the ultimate market for carbon, and which will be reaching to households, and people will be also thinking about creating it, because once you create the market, you have a lot of products coming in, and good quality of carbon credits will be there. I think EKI, Manish Dabkara works a lot in this domain, and I think he's one of the guys who can be tapped to give more details. As per our discussion, he told that the carbon credit derived from technology has higher credibility in the market as compared to nature-based, which means that if you have air pollution, if you're putting technology to cut down air pollution, so the deficit that you have, the difference, you can convert that into carbon credit, and that has higher price in the international market as compared to nature-based. In Northeast India, you have a bamboo cultivation. People also have good scope to go there, and then they can also think about. But overall, what coming back to your question, we can't go for mandatory carbon pricing or carbon trading as of now. We'll have to go for voluntary, and we'll keep this open until we achieve the optimal growth rate of 12%, 13%, and then we can make it mandatory, and then everyone will be happy, because when you have more economic activity, more pollution, good for the market, carbon market and others. If you have a slowdown, not good for the market, especially the climate change based product, right? We saw that during 2007-8 global financial crisis, the carbon prices were crashed almost, because less pollution, less economic activity, people were unemployed. But as we go on more economic activity, we'll see a big boost to this particular sector. So I hope I have answered your question. Thank you.
Yeah, yes, sir. So we wish you, sir, net zero birthday for your future. Yeah. So now we are having many questions, sir. So I would like to take a few of it. So first question has been asked by the Kilari. He's asking, what exactly is the terminal value? That does it has any direct and indirect relation or impact on green bonds and carbon bonds? So
No. In terminal value is when you do equity valuation. So I was doing that for 10 years. So before joining this climate finance, so you will see you do this free cash flow generation. Okay, so you cannot, I mean, You cannot do free cash flow for 100 years. You will do for 5 years, 7 years, then you will stop. Okay, then there is a formula called free cash flow multiplied by 1 plus growth rate divided by R minus G. Okay, so that's what terminal value is. Okay, I'm not discussing, it's a financial theory class. So, but it has nothing to do with the green bonds or carbon bonds. Bond is very different actually. So, I mean, there is a big question mark also. I keep on asking whether green bonds is really useful for investors issuer. It has done its job so far, but I don't think that it's really helping investors and the issuers. Okay, that's a different question. So terminal value has nothing to do with green bonds or carbon bonds. Yeah, that's my answer.
So now, sir, these SLBs are very much in talk of the town. So sustainability link bond with the KPIs, does it working in the market?
Actually, these companies, they're gaming it. Okay, so what they are doing, they already achieved their target, and they are coming out with sustainable link bonds. They know that under the business as usual condition, they will meet their target, and they will derive the benefit of a lower interest rate. Then they come out with issuance of sustainable link bonds. Okay, in a business as usual scenario, they can achieve that. But I would like to emphasize one thing here. You cannot reduce carbon emissions significantly, like Professor Mawashim said, in hard to decarbonize industry. You take a longer time to do that. And unfortunately, most of the SLBs are issued for a short period of time, even for transition bond also. In a short period of time, you are not going to invest heavily in low carbon technologies. You are not going to invest in research and development, or you are not going to change your business model, okay, and align yourself to a low carbon technologies. Everything can be achieved in the long term in a hard to decarbonize industries. So by issuing 4 years or 5 years or 6 years bond and reducing carbon emission by let's say 10% or 15%, and if you know that you can do that, and you already know that you can achieve that matrix, it doesn't make sense. It only makes sense if it is ambitious, if it is very, very ambitious and much significantly higher than industry than the industry metrics, then it makes sense to issue to this kind of bonds.
Okay. Okay. So, Wasim sir, to you, can you please mention the model which tells percentage of GDP loss with respect to climate change? Are there any new model which adopt AI?
Yes, so I think Hong 2025 model talks about, and they basically capture the regional heterogeneity also, and they also bring a lot of dimensions regarding qualitative dimensions which were not quantitative earlier. So a lot of AI based models are in the news, and you can also search IPCC. Also, the assessment report mentions about to some extent those details. WRI also has one or two reports which they mention and the models that they use. But here you can think about the challenges that you have. You cannot just define a Northern kind of model, and you can simply say that household is consuming two goods and two goods are having this bad constraint. No. In case of climate change, we have to add behavioral dimension also, right? So AI is
Yes.
helping in that way a lot. So cognitive behavior of an individual is being captured now through AI. So what kind of social media activity people are doing, how much you have a likes, if you are posting a climate news, right? There are open sources. I recently explored the US market and I worked on the television news data for the first time, video data. So that tells that if you have snippets being discussed on the television news, then how it is impacting investors. So that kind of setup, I think, if you ask me about the model, so so Fung and Hang model 2025, it talks about AI based, and that can be studied. And I tried to go through the model. It is a bit complex, but it's still understandable, and abstract gives a good amount of detail. And it improvises on all the earlier models.
Yeah. So there are a few questions which I would like to answer here. One, Sudhir Kumar Biswal is asking about default probability and credit risk assessment. The various research paper is discussing various model. They have made the model out of it, means by incorporating
No,
VACC and its impact on financial.
I
Yeah,
think I can give a damage. For example,
yes, sir.
In Basel 2, we calculate PDs, right? Probability of default.
Default.
So we do it. We do it through cross-section models. We apply logistic regression. So the HSBC hire a lot of people just to run the logistic regression for years. They run. What is the you have the history of investors or account holder KYC that you have. You have KYC data, name, age, location, the income, how much he spends. They have all the data. You run against a probability that whether he default or not default, right? And then you go for. Then you have something called exposure at default. You have defaulted the loan. For example, you are having a car of 8 lakh rupees and 3 lakh rupees was outstanding. 5 lakh rupees you have paid. Now, when you defaulted, the bank had the balance of 3 lakh rupees on you, right? Now, this 3 lakh rupees, whether the bank is able to recover after selling the car, if it is going to recover after selling the car, then exposure at default is zero. But if it is not going to recover, then whatever the residual amount that becomes the exposure at default, like 3 lakh rupees at that time, and then it can be further calculated with regard to how much is the margin of the loss that the bank experienced. So after selling, if the company sells the car at 1,50,000, so 1,50,000 is still is the loss for the bank, right? So I think that is related with the banking sector regulation. You can apply to the companies also, whether company will get the loan or not get the loan with rest of the indicators that you have on right side. Left side, you can put this 0, 1 scenario. So you can read the logit, probit, tobit models. I think those models will going to help you.
Yeah, the same, the bank using the logic model and the parameter you just need to change. Some researchers are also using this Altman Z score for the default of the banks
Yeah,
and
so
default of
it
the
started
company.
with Basel 2, and now we are into Basel 3, so we are talking about leverage and all other scenarios.
So Sunidhi Rani Singh is asking about ESG score and ESG related data. So see, BRSR is the best
Apologies for
data
the
source for this.
interruption, sir.
Sorry.
Apologies for the interruption. One or two
Yeah.
more questions, then we are wind up the session.
Okay. Okay. Fine. Yeah. So here I will take one more session. Venkat Avdani is asking to Dr. Jeena, don't you think that fiduciary thing you talk about the protecting planet is not a duty fund managers is the malady? When you say sustainable business, the thought of fiduciary duty doesn't make any sense. The laws concept made during a mercantile era may not make such sense. The concept need to be rewritten. Your views.
No, I absolutely agree because the only issue is that I think there is a case in beginning of in 1920th or something, this fiduciary duty. Okay, so fiduciary duty to you are the ultimate beneficiary. Here you are talking about investors. Unless the asset manager convinces the investors, I am working in the best interest of yours. Okay, you cannot say that you are performing your fiduciary duty. Now the question is that whether climate change risk uh, is real. Okay, that's one. Second is that even if it is real, whether it is affecting your portfolios, okay, making your portfolio better or making your portfolio worse. Or you, if you are investing in low carbon technology, putting the securities or bonds in your portfolio, you can perform better than your peers. If if you can able to convince that, then you are doing your fiduciary duty. Okay, so that convincing, I don't know from where it will come. Nobody knows because most of the risks are going to be realized in the future. Because when we are talking about climate change risk, it's mostly futuristic in nature, but academically, some of the academic papers like Professor Watsi must have seen, Dr. Neeraj, you must have seen, they have also considered the forward-looking risk and created portfolio according to that. Then you may be able to convince the investors that, okay, I'm working in the best interest of yours. But there is a possibility that there is something called portfolio manager who are very, I mean, I will say climate enthusiastic or thinking that, okay,
Yeah.
My job is also to protect the planet, okay, because I want to be a good citizen. It's a problem. Okay, it's a
Yeah.
problem in the sense that you are not doing your best. Okay.
Mm.
But I would like to add another point here. For a large bank or large asset manager, they are universal owner of assets, of financial assets. You are not owning a company, couple of companies, your portfolio. You are owning the entire economy or so. Then you need to see that at a company level, how your financial asset is going to perform. There, when the climate change risk will matter, because since there is an unanimous between academicians and practitioners, climate change risk is real and it is going to affect us. Then you need to see that, okay, how at individual fund level, how I can incorporate, at the same time convince my beneficiary that, okay, this is good. Because I believe that some of the pension funds, I think in Texas or so, they dragged their pension funds to the court and say that, okay, you are not doing your duty, I'm withdrawing the money from you. Okay, that also
Yeah.
happened.
Yeah. Okay. Thank you. Well articulated, Labanna ji. So, due to time constraint, we are not able to take much of the questions. So many questions here, almost 29 questions. So definitely, I will club these questions, and if panel permits, so I will send to them. Or see, we all are the very much searchable on the social media, especially LinkedIn. You can reach to Professor Wasim or Professor Labanya or asking these questions. So with this, I would like to thank very warmly and very much to the Professor Labanya Prakash Jina, also Professor Wasim Ahmad for
I'm not
uh,
a professor, Dr. Miraz. So you
but you are pursuing your
Knowledge
almost
matters.
completing your PhD, so hopefully you will join our fraternity also. Yeah. So thank you very much, all of you. And with this, now I have some announcement to be made on behalf of NISM. Uh, uh, Let me, okay. So one announcement is related to our course of the financial planning. It is related to the financial process, risk management, and all. So I would like to share the screen. So one course is related to this financial planning. It's a e-program, and you will get through our portal. Second one is another course for the financial planning. We have the launch, which is advanced level. Those who want to learn about the goal prioritization, time value of money, retirement planning. So it is a best resources. And next certificate in collaboration with the CRISIL we have launched, which is ESG risk analysis program. Rather buy side or sell side, it is a very beneficial certificate. So here you will learn about the ESG concept framework, reporting standard, regulatory compliance related to ESG. So these are a few announcements. With this, again, I would like to thank all of the esteemed panelists, and also a special thanks to Rasmeet, who has made the idea of this to have the panel discussion on this environmental day. So thank you, Rasmeet, for your inputs, and thank you very much for all the audience for means almost 200 people continuously was attending this program online, but through the on the different social media also we were live. So for this webinar, almost 500 people have registered. I guess almost 300 people has benefited from this webinar. Thank you very much for the all the audience and giving your inputs also. We are receiving lots of thank also in the chat box. Thank you very much. So we will stop here. We will call it a day. Thank you very much.
Thank you.
Thank you very much.
Thank you, Dr. Miraj. Thank you, NISM.
Nice to meet you,
Thank
Professor Wasim. Yeah, bye.